I think the transition is going to be rocky, even if you're convinced, which I think I am, but not certain, that we're going to a better economic system. Even if we believe that's happening, the transition is going to be rocky. So 2026 is when we should really start marking our scorecard for wins and losses. If
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Jim Urio, a managing director of TJM Institutional Services and a veteran futures and options trader. The majority of Jim's 30-year career has been spent brokering futures and options trades for large institutional clients in equity indexes, interest rate products, commodities, and foreign exchange. His recommendations to clients blend macroeconomic themes with technical analysis to identify trading opportunities, anomalies in options markets, and hedging strategies. Jim, welcome to Metals and Miners, and thank you so much for joining us today.
Thank you. And by the way, it just dawned on me that I'm going to have to change that bio to 40-year career in 1 year. This age thing is creeping up on me. Right?
Yeah, but you look 35.
I appreciate that, Gary. I'm glad I came on.
All right. So, Jim, let's begin with Jerome Powell's presser from the other day, where Powell leaned on the word uncertainty a lot. He restated an old position also on inflation, that he believes that inflation will be transitory. But the vast majority of the FOMC members, they see higher core inflation risk, as 18 of the 19 members see upside inflation risk. That's even more skewed to the upside than June of 2022. That was peak inflation. So in other words, the committee appeared to be more in agreement over the threat of inflation than in mid-2022 when they hiked 75 basis points. So there's a huge and stark disconnect between the FOMC and what Powell represented. Your reaction?
So what's funny is that, first of all, the nerve of that guy, and again, he seems like a hell of a good guy, but the nerve of that guy to use the word transitory, which is the word, the operative word from 2021, when June of which we saw 5% CPI and the housing market was inarguably on fire, and he'd said inflation is transitory and hit the gas for the next year of buying bonds, which was absurd, by the way. So the press release now that he says that he thinks uncertainty. Okay, uncertainty is a crutch right then. But of course we're uncertain. We're going from a wildly different macroeconomic theory and policy of the last administration to this new one. I believe that it would be a rocky road. So what he maybe is saying is that these tariffs may or may not be inflationary, which guess what? Tariffs may or may not be inflationary. So if they are inflationary, they're inflationary in the short term, supposedly. And we don't even know if Trump's really going to institute the tariffs he says. But now the most interesting part of the whole thing is disregard everything he said at the presser, because he genuinely did ease rates. When you say the market thinks you are going to let $25 billion in your quantitative tightening roll off every month, and you come on and say all the words that he said, but then at the end say, oh yeah, we're reducing the amount of run off our balance sheet from $25 billion to $5 billion. That's easing rates. It's less tightening. And I think it's actually a walk back to quantitative easing, which is what they'll eventually do because of the amount of bonds we have to sell. And you saw what gold did after that announcement. Gold saw right through it and like, what? The dude just eased. So that's why gold was up $40 that day. I know it gave a little bit of it back yesterday, but gold did the right response, as did stocks. Stocks rallied hard too when he said it because he was easing, but stocks can't keep that because that move in equity markets. And I'm sorry if I'm ranting, Gary. I get excited after a couple cups of coffee. Okay, good. The stock market reversed it because the stock market is trading now just not based on the fundamental catalyst for the correction. Now it's just about the second layer of the correction, which is repositioning and reassessment of risk. And that's the good element of a correction that has to happen for us to find the base. But the reaction to Jerome Powell was correct. It was an easing. Regardless of any of the words that anyone said, he eased.
So you really walked right into my next question, and that's the reduction of the quantitative tightening, the roll-off from 25 billion down to 5 billion. You mentioned QE. My question is do asset markets really need QE in 2025 to prevent a global debt refinancing air pocket from the almost 10 trillion in treasuries needing refinance plus all the new debt? And is that exactly what they're going to get, QE?
So, okay, this is really interesting because as you've seen, 10-year yields have gone down, meaning demand has gone up for our bonds, which, by the way, is a really interesting anomaly considering the last 2 years we've had several long-term auctions that did not go very well, meaning the global appetite for our bonds at those spending levels wasn't that high. Well, now that we are buying our bonds. So, and we're talking a really great game about cutting spending. As you know, we haven't really cut spending very much. And talking about Doge and talking about, oh, we can cut 2 billion here and 2 billion there. One, you have to do it. And then you have to come to the realization that cutting 1 and 2 billion here and there isn't really going to move the needle that much. So I think the fact that they're buying our bonds, you saw the headline about Germany adding big stimulus. Okay. Germany potentially funding its own military, which, by the way, I saw just as a quick aside note for the lightheartedness of it. Someone from Germany posted a couple weeks ago saying, so let me get this straight. The Western world wants us to raise our own army, march through Poland, and challenge the Russians. I was like, that won the internet for the week, in my opinion.
It's unbelievable.
But that being said, if Germany and Europe in general is going to be funding much of their own military operations, we then can cut back to 8% on the defense spending, which Donald Trump has mentioned several times. Whether we do it or not, I'm not certain. Again, this is good talk. And right now the market's reflecting some good talk, but I'm not sure if it has meat on the bone.
Well, and with all the what did Musk call those computers? The magic money making computers.
Yes.
With all the magic money making computers that are there, especially at the DoD. I mean, even if Doge finds stuff, or even if Hegseth, cuts down, or if this 8% gets chopped out, somebody could still deploy those magic money computers and still spend money. So
sure. And by the way, and the magic money computers, I mean, that's a standard way of our banking system. I agree that it's a little bit alarming that people have the power to just create money out of thin air, but the Federal Reserve has been creating money out of thin air for since they began quantitative tightening, which is amazing to me. One thing that we should keep an eye on, by the way, is M2 money supply. After it was contracted 4.6% from its highs, I think in 2022, I'll say, but I might get the dates a little bit wrong. It has started to go higher again. Mm-hmm. I think things like M2 money supply growth and Fed's balance sheet, which is inextricably linked to that concept, is very positive for risk assets. The stock market, I still think, needs to go through some more corrective phases, but I'm not an end of the world kind of guy, and that risk assets are going to plummet or that the stock market is going to trade down 30%. I think 15% is more than reasonable, and I think that's what we're going to get.
Okay, I appreciate you saying that. And I do have a question on the M2 here in a moment. But Jim, after the presser was over, Trump urged the Fed to cut rates. I'm sure you saw that tweet that he made, or on his Truth Social. So he urged the Fed to cut rates as tariffs ease into the economy. But he called April 2nd Liberation Day, the day essentially that reciprocal tariffs are enacted. But, Trump is also cryptic in many ways. He's usually using double entendres. He's saying extra things in his words. Is there something more behind the phrase Liberation Day? What is he trying to tell us that we're being liberated from?
I think he, in his mind, at least this is what he's trying to convey. Like you said, too, he believes that he is the master negotiator and that every face he shows, we are not supposed to take literally. Trump, you should take seriously, but not literally, because oftentimes it's just a front to get what he wants from the negotiating table. What he's saying is that, in my opinion, of course, is that everybody on the left who points to him and says, see, he's anti-free trade, but he's saying, no, I'm pro-free trade, and I'm trying to get these countries to drop the tariffs they've had on us for a long time. When Howard Lutnick came out and described the tariffs that Europe charges us that are legacy tariffs for World War II, I think a lot of logical and clear-thinking people are like, what? We're still rebuilding Europe after World War II? I mean, that was literally 80 years ago. So I think what he's saying is that we are on a path to freer and more balanced trade agreements if these countries will agree to drop. Because when you say these are going to be reciprocal tariffs, and I guess this is a question to you, Gary, isn't implied in that if they reduce their tariffs, we will reduce our tariffs as well? Because it seems it to me. Yeah.
Right. Yeah. And he's even said yesterday that he has flexibility also on the tariff. So, he's clearly keeping every option open. And I think, to your point, he doesn't want Canada to have a 250% tariff on something and, allowing their goods to come into our country unfettered, but our goods are getting stifled at the border.
Right.
So,
and it's been going on, like I said, for many, many years. Have countries been taking advantage of us in trade? Yes, of course they have. It hasn't been a big deal. Our economic engine was just so much more powerful than everybody else's. It almost seemed like fine to be supporting some of these countries around the world. But some of these countries don't seem to have our best interest in mind all the time. And I'm talking particularly about China. And yeah, we should be probably tariffing China. I think I'm in total support of that. With Canada and Mexico, the goals seem a little bit more murky because he does throw in the fentanyl thing. He does throw in the porous borders. And the only problem I have with those, I mean, it's a noble goal, but it's not definable by the markets. And when the markets can't define something, they get a little bit scared. And that's part of the transition we're seeing in 2025.
Yeah. And I think, to your point, it is murky, and it's probably murkier for a reason, and, you saw the executive order come out the other day on the minerals. And it's, Canada and Mexico are so rich in minerals, and they're already much further down the road. It takes 10 to 20 years to get a producing mine up and running, but they've already got a lot started way ahead of us. To me, it makes a lot of sense that he's angling for some of the natural resources here.
Yeah, and I like that too. By the way, can I ask you a quick question on this? So you said about the time it takes to start a mine in Canada here and in Mexico. And I'm thinking in terms of like nuclear plants as well. And I know that might not be your purview, but here it takes 15 years for all the permitting and all the regulations. And in Russia and in China, it takes 4 years. Is mining similar to that? Are there really restrictive regulations?
Very.
Is it state by state in this country particularly, right?
Very, very.
So,
and that's, I think, part of the reason for the executive order is he's trying to ease some of those restrictions because of the dire situation.
Right. In his mind, he probably is also thinking you can't fight states in their regulatory positions like California, Illinois, and there's never going to be mines in these states because the climate people are so entrenched that they will fight you at every turn. And he's probably, just trying to negotiate with them to get more mineral rights. I think that is probably not a bad thing. Now, the way Trump goes about things is clumsy. He swings a sledgehammer oftentimes, which a lot of people don't love. I don't love it. And I voted for Donald Trump, I don't want people to confuse that with me being some sort of Trump supporter. But some of these policies, if I squint and tilt my head, I agree with. And the other policies, I thought they were spending too much damn money. And by the way, back to the gold thing, and I know that's your purview, I thought the last administration, and had they carried the election, was going to be terrific for gold. I'd said that going up to the election. I thought one candidate was great for gold. The other is just pretty good for gold. The one who was pretty good for gold won. But most of his policies I agree with on some level.
Yeah, and whether folks agree with the specific policies or not, I think what we could all agree on is that the country has gotten to a place that is completely unsustainable. And if there is no course correction, there will be some major repercussions coming down the pike. And so to do something different, to get different results, had to be done. He's the choice to get that, to get the different actions in place.
Yeah, so almost like Neville Chamberlain and Winston Churchill was like a wartime leader versus a peacetime leader. I think the people, particularly in the financial world, looked at the $37 trillion debt, looked at the fact that we were accumulating $1 trillion of debt every 95 days toward the end of it, said, this is clearly unsustainable. And this is those modern monetary theorists who have crept their way into government, whisper in these politicians' ears, you can spend as much money as you want. And guess what? Politicians love to hear that message. And the notion that because I don't know how familiar you are with modern monetary theory, but it is the most asinine concept on the planet because you can spend as much as you want because the United States has so many resources we can borrow against that. That part's true. Now, here's the cute part in it. They say, if you see inflation start to rise, you raise taxes real quickly to absorb money out of the system. Well, there's two huge flaws right there. The government has never been able to see inflation when it slaps them in the face. Any non-traditional inflation, 2021, the inflation was in tech stocks. 2026, the inflation was in real estate. The government just wildly missed both those signs. All they can see is Wonder Bread prices, which is what the CPI index is. Secondly, no politician is going to quickly raise taxes in the middle of an election cycle. So implicit in this whole deal is that we have to have permanent politicians. I'm not on board. The whole thing was asinine.
I totally agree with that. All right, so let's go back to the debt you just talked about, the 37 trillion. Over the next 4 years, 28 of that 37 trillion is maturing. $28 trillion. So financing current deficits is going to also add another, 10 trillion, let's just call it, or so to that number. So now we're up to $38 trillion in 4 years that has to be financed. Is there any way the U.S. can sell $38 trillion of treasuries with a 4% handle on it? I mean, is this a situation where either the U.S. pays 6 or 7% or more, or the Fed has to buy it all? You know, what's really coming our way here, Jim?
Own gold. Because you just pointed out a very, very tricky situation. Now, there are many smart people who right now believe that Scott Bessent, Donald Trump, they're in some ways, maybe not overtly, but in some ways trying to engineer some level of recession and a rotation out of stocks into bonds. And I think that's part of the reason that 10-year yields have gone lower. But I think it would take a lot more. But they want to refinance that debt, $9 trillion alone this year. They want to refinance that debt at a lower rate. And 5%,
but not on the short end. Not on the short end.
Not on the short end. Again, remember that the previous Treasury Secretary zapped so much of the short end liquidity that we are now forced. You know, they ran down the reverse repo. There had been $3 trillion in there, and now there's like $150,000 in reverse repo facilities, and that's money that's just waiting for short-term debt to absorb it. That's the way I always try to explain that to people. So now that that's mostly gone, we have to sell long-term debt. So we have to convince the world that we're on a better and more sustainable path, or else they're not going to buy it, and rates are going to shoot up to 8%. Now, I've said for a couple years that I think above 5% in the 10-year, maybe it's 5.25, maybe it's 5.5, but that's when the Fed will step back in and start supporting the bond market and buying bonds themselves. I think that'll be death for the dollar, and not death for the dollar against the euro and the yen, which the dollar index is such a
just
ridiculous.
A devaluation.
Yeah, devalue. And again, we've devalued the dollar probably 30% in the last 3 years alone. And everybody looks at the dollar index and says, no, we're not. The dollar's strong. Yeah, the dollar's strong if you're not working a side job to buy more euros and yen. You're working a side job to buy more eggs and beef. The dollar's weak, not strong. Gold is reflecting that the dollar's weak, not strong. That dollar index, you can have it. Did I answer the question? I forgot what the question was. I was rolling there, and I don't know what the question was, but it's fun.
Yeah, that was good. That was good. Okay, so to continue, let's go back to your comment on the markets here. Okay, you do believe a correction's coming. You're not a 30% guy, but in the last 3 months, there's been a record rotation out of stocks by big money. This is one of the biggest de-risking events that some managers have ever witnessed. 70% points of repositioning within 3 months. That's simply not seen before. Combined with all the billionaires selling over the last 12 months and Warren Buffett sitting on now close to an absurd record cash pile of close to $350 billion. And he has repeatedly stated in all of his shareholder letters that he hates to be in cash in lieu of good equities. But here he is sitting on almost $350 billion. We don't have an anomaly here. I mean, what do we really have here? What is big money getting out of the way of?
So I think they're afraid of the transition, and they realize that the market had gained 25% 2 years in a row. It doesn't often do that 3 years in a row. Back to Buffett's stockpile of cash, though, one thing that we are forgetting, we should mention every time he says it, is that we guys our age, and I'm a bit older than you, but over the last 20 years, we viewed cash on the sideline as dry powder, ready to be deployed into risk assets. Well, that's not really the case when you're earning 4.5% on your 2-year money, presumably some of it that he locked in. So it's not as much dry powder. I think there are plenty of asset managers who view that as money that's performing, and now we can be a lot more selective of what we want in the stock market. which is fine. But everybody getting out of that made sense to me. And when 2025 began, I went on every show I could. I said, if you guys think that Donald Trump has the corporate sectors back and that means that everything is going to go well, no, these are transitions that are going to be inelegant. And it's already started that way. And I think 2025 is going to be a crap year in risk assets and potentially in the economy. I think both of those things are way more linked than they normally were. And to prove that point, the top 10% of the asset holders were accounting for 50% of the consumer spending over the last year. That is an unsustainable ratio as well. We definitely had a K-shaped recovery after 2020, where the poor and the middle class, the non-asset holders, lost money due to inflation, and the top 20%, the asset holders, made a crap ton of money on their real estate and their stock.
And to your point, in 22, when we saw the stock market dip pretty hard, spending went down and ultimately taxes went down. They both went back up in 23 and 24 as we saw the market go back up. So the market and the economy is very linked together.
More so than normal, because every economist for the last 30 years likes to say, well, the stock market and the economy are not the same thing. And that's often the truth. Right now, the stock market and the economy are more the same thing than they've been in the past.
So then does the Fed have motivation to ensure that the market stays elevated?
I think they do. I think the Fed, their legacy is important to them. And I don't think that Jerome Powell wants to be at the helm when there's a excuse me, I'm sorry, Gary, when there's a massive correction in the stock market, because a massive correction in the stock market, like we just said, implies a massive slowdown in the economy as well. And I think Jerome Powell, I think there is a Fed put. And I think that's one of the bad parts about having humans run the Fed at this point in time. And everyone, I'm not necessarily an end the Fed guy, but I think there should be much more automated signals that take the emotion out of this, because I do think these guys worry about the downside. Now, you go. Yeah.
So bring in the robots?
Well, okay. You and I think we could come up with 30 different data points and come up with an algo formula of when we're supposed to. And again, remember, the Fed is not supposed to stop recessions from coming. They really, when they made their case for being a going concern, it was to take the sharpest edge off recessions. I think they've morphed into something that was never really intended, them to try to keep everything for recession. And by the way, you're in gold, metal, miners. This opinion of mine has made me money, because I've been in these in metals, because I believe that the Fed is somewhat irresponsible and flawed.
Okay, so that's a good transition point. So by some expert reports, Jim, there's potentially $5 trillion in equities being quietly offloaded. A key question is, where are they going to allocate to? So bonds could see some flows, but bonds have not really been attractive for quite some time, and for many reasons. Europe is weak. Asia isn't attractive for U.S. investors. Inflation isn't going away. Banks are re-rating their gold price expectations much higher. The real question is gold emerging as the new TINA? There is no alternative.
Oh, yeah, I believe that for sure. Now, there's a funny quote that, because I can't remember who said it, I'm pretending that I made it up. It is that Europe is a museum, Japan is an old folks home, and China is a prison. So where would you rather invest? The United States is the answer. So right now, the stock market is persona non grata, just because it's going through a transition phase, which I think is eventually going to be fine. But then you get to U.S. bonds, which people have been buying them since, the rates have gone from 5% to 4.2% essentially. And then gold. There's very little alternative. I think if you read Larry McMillan's book about When Markets Talk, Listen, he makes this point. He says that a commodity supercycle happens when inflation is at a certain level and the Fed's not fighting it as much as they should. And the Fed's not fighting as much as they should. Jerome Powell comes out and says he wants 2% inflation. He knows full well that the federal debt, the big five states' debt, which I'm sitting in one of them, cannot be handled unless there's an element of monetization of the debt. Keep M2 growing, make the dollar cheaper, let them service their debt with cheaper dollars. I think Jerome Powell wants that. And that's why my whole dollar hedge portfolio, which I instituted probably 4 years ago, is gold, silver, copper, Bitcoin, real estate. And that's been my main focus for a couple of years. I've been referred to as a gold bug for 3 years. I'm like, I'm not a gold bug at all. I did the math, I did the data. gold looked to be the best place to be. And everyone's like, well, you can't earn interest rate on your gold. Yeah, you can. I could teach you how to earn interest rate on your gold through options market. I do it all the time. It's fine.
Okay, I appreciate all you just said there. So in an executive order on February 21st, President Trump basically told China to take their money home or face stiff taxes. Did you see that?
I did.
Okay.
Yeah.
Since that date, the NASDAQ is down about 15% or so. Since 2014, China hasn't bought treasuries on net. Okay. They've been buying a lot of gold, a lot of stocks, among other real assets around the world. They have many trillions still in the markets. They have pulled out some over the last month or so. But they don't just bring money home just to sit. They literally buy real assets. So some of that money that they've pulled out of the U.S. market since February 21st, it's gone into markets around the world, including Germany and their own market. And then a lot has gone into physical gold. Until the Trump administration changes course here, which is unlikely anytime soon. They literally just implemented this policy decision. So until they change course, do you expect that these flows to continue out of the U.S. markets, specifically the NASDAQ, and into foreign markets and gold?
I don't expect it to continue. I think it's a short-term anomaly. To put in perspective about what you're saying about gold, like in 2022, global central banks bought 1,100 tons of gold, a record since we've been keeping records. 2023, pretty much the same amount. 2024, the first half, it was a record first half. We don't have the data yet for the second half of 2024. However, that being said, is that this all relates in some ways to the United States like being tough on the globe. When we froze Russia out of the SWIFT payment system, froze up all the dollar-denominated assets, we saw an acceleration of de-dollarizing and buying gold. Now, I said de-dollarizing. I don't believe that there's this huge de-dollarization thing that's going on that's going to have massive ramifications. I think that Mike Tyson always says everybody has a plan until they get punched in the face. And it is easy for these central banks to say, oh, we don't need your dollars, although they're still buying some of the dollars. But as soon as there's any sort of a global crisis, what will we see? They will flock back to the dollars so quickly. But anyway, our job as traders and investors is not necessarily to see what the actual end game outcome is going to be. It's try to predict people's behavior in the short term. And in the short term, they keep buying gold. Like you said, they keep buying around the globe as well, too. But I think gold will be the main thing. As far as Europe goes, and everyone, it's really fashionable today. And I don't know when this pod's going to come out, but over the last 2 weeks, the euro has screamed higher. Euro stocks have screamed higher. That was a function of two things. Is that one, we had kind of put Europe like they were dead and gone over the last few months. Like Europe was never going to recover. That what I just said about them being a museum was commonly said. Okay, so maybe Europe wasn't as dead as we thought. Two, Germany puts in this big stimulus package too. I think this is a massive mean reversion trade. A lot of people were short the euro, long the dollar. I mean, we always talk about the yen carry trade. I think a lot of people were positioned that way too, a short European stocks to be long U.S. stocks. And I think we're getting out of that trade. Do I think Europe's going to be the place for everybody to invest over the next couple of years? Hell no. And the reason is that they are so restrictive in their governments, they won't allow people to do anything. And I think the investors who are plowing their money into those places right now are going to realize that pretty quickly.
Not to mention the war drums that they're beating. I mean, they are beating the war drums hard. And as soon as the bullets start to fly, that money's out of there.
There's no question about it. This is an insane path that we had been put on, and Europe is part of that. Yes.
Yeah. All right. So you mentioned earlier, Jim, about the M2 money supply. So there's been an acceleration. It reached 21.6 trillion in January. That was a 3.9% year over year increase. That's the fastest in 30 months. So also considering the concurrent global money supply increase of 2 trillion over the last 2 months to its highest level since back in September, how might these monetary expansions influence gold prices in both the short term, say 0 to 12 months, and the long term beyond 12 months?
Well, I think it already has in many ways. And one of the huge run-ups in gold we've seen is because of global liquidity, global money supply increases. And I don't think that's going to stop anytime soon. We talk about, Donald Trump's acting. And again, I kind of implied this before, and I want to underscore it now. Donald Trump has been talking a great game about cutting spending. There's been nothing very material so far. And if he doesn't cut spending, gold is going to scream higher, as is real estate, as is some of the other assets that we talked about before. And I don't think that's going to change. I think just look at the gold silver ratio. Is that something you look at quite a bit, though, by the way?
Yeah, it's in the high 80s to around 90 right now.
Yeah, so 91 is what I thought was good. So gold is outperforming silver quite a bit. To me, that's a commentary on storing money as just storing it versus the whatever the kind of economic component of it. So you probably know this better than me. In my mind, I always think of gold as pretty much 95% a precious metal. Silver is about 75% a precious metal, 25% an industrial metal because of its conductivity properties. Do you think that's a fair ratio?
I mean, I don't really, I think we're taking a stab, so it really doesn't matter.
There's no question we're taking a stab, but that's funny. But not only are we taking a stab of what we think, we're kind of taking a stab of what the market thinks too, right? So and again, we're just trying to front run the market if we're trying to make money in investments. So, right. And I think that silver's weakness compared to gold is but silver's strong too, by the way, which is interesting, is reflecting a belief that we're just going to, some of the trillions you talked about, it just kind of has to flow someplace. So do you want to buy Bitcoin? Well, Bitcoin's getting the crap knocked out of it because it's just correlated with the NASDAQ, which actually that's a whole other discussion too, gold versus Bitcoin, which I think is fascinating because Bitcoin is correlated with the NASDAQ. And that's a fundamental thing that happened when these big trading rooms started trading Bitcoin. They were like, well, let's just give it to the NASDAQ guys. They're used to volatility. So what tended to happen over the last 10 years is that the positions are kind of the same. I'm long NASDAQ, we're long the Bitcoin. If one goes down, you have to sell the other to meet margin. And now you talked about China, and a lot of people realize that China had been buying bonds for whatever too. But a lot of times what people don't realize is that China has huge positions in the NASDAQ, which you said, which I'm so glad you mentioned it too, because it's a big deal. If they start moving their money out, the NASDAQ is going to suffer. When the NASDAQ suffers, Bitcoin suffers. So all of a sudden, if Bitcoin's supposed to be the major challenger to gold and it's just getting sold off with the NASDAQ, well, there's a problem. Obviously, Bitcoin isn't serving what its primary function was supposed to be. And again, that kind of pulls the wallpaper back, and what's left? Gold.
Okay. You mentioned silver. I want to touch on silver here for a moment. Some experts believe it has been strong and it's been hovering around, it busted through the $32 to $33 resistance level. It's got another one to bust through here in that 35 to 37 range. And once it gets through there, there's a lot less resistance getting to 50, which is the all-time high. Some experts believe that the $50 silver price all-time high is equivalent in terms of threshold to the $2,000 gold level, the approximate $2,000 gold that it had for all-time highs, which it broke through last year. And that once the $50 threshold is finally broken through, it will do what gold has done since, and it'll take off and go much higher. Your reaction?
So gold and silver, the relationship has been interesting, is that it usually gold leads the moves and then silver catches up, and it catches up rapidly. So you mentioned $50, which is funny because the average gold to silver ratio from call it 1997 to 2017, the average gold to silver ratio was 60. That implies right now a $50, because just think about it, 30, and I know you know what I'm talking about, just in case people are watching, $3,000 gold. If the average ratio in that time period was 60, what would the value of silver be? And that would be 50. You mentioned $50. So it's obviously a big psychological level, and it pulls it back to that average. Now, that being said, the average from 2017 to now of the gold silver ratio is more around 80. And it seems to keep going from 90 down to 80, 90 down to 80. And now it's at 91. So if it goes down to 80 in the next couple months, that implies about a 38. I'm just doing the thumbnail math. I think that implies about a $38 silver, which we're at 33.5 right now. So it's still it's still a nice 10% move higher. But I like what you're saying about 50 because that's what I kind of have on my targets, and I am long silver.
Okay. All right. So Jim, with gold's bullishness, tech's bearishness, and emerging stock market bullishness right now, all in combination, does that layout now put miners on the investor's radar?
Okay. Yes, there's no question about it. And miners have been a big underperformer. And I think that's because when it starts to hit the fan, you grab what you know, and people know gold. When you start to invest in miners, you then all of a sudden have management teams, you have regulations, you have a lot of stuff to deal with when you're buying the miners. So that to me is a far more secondary trade. The fact that it hasn't really kept up, and again, and I'm not long. Well, I am. Yeah, that is actually not true. I am long a couple miners, but it's not a big position. So I'm just looking at the commodity itself. But I do believe that as it gets kind of comfortable above the 3,000 level, the next shoe to drop will be people looking at the miners and trying to pick the best ones there. I don't do that. I mean, I have some gold miners. I have some analysts who do it. I like to look at the macro picture, kind of a top-down thing. And if I want to buy gold, I want to buy gold. I don't want to bet money on some management team that I don't know the guy at all. Does that make sense?
Yeah. So
Can
now
I get your opinion on the miners too? Do you think people are going to start buying the miners soon?
I don't see how they could avoid seeing how much free cash flow is being generated and how much eventually it's going to lead to, in my opinion, mergers and acquisitions where they don't even have to use the equity anymore. Right. So they could use cash.
Why the hell haven't people been buying them so far?
That
makes no sense to me.
I think everybody wants to know that. I think everybody's been worried that a huge recession is coming. But if there's no recession coming, if we go into a malaise, a flat line, but not a drop, money's going to likely rotate out of the market, I would think, because people are going to want gains. Yeah. And where is their, low PE, high free cash flow, et cetera? It's in the miners.
Right. And by the way, which I'm looking very closely at the miners for what you just said. And I think there's going to be a switch that gets flipped and people are going to buy them. There's one ETF that's the big miners, and then there's another ETF that's the junior miners, and they both slip my mind right now. Do you remember
GDX and GDXJ?
Yeah, that's what I'm talking about. Right, exactly. So I will be looking at those charts because it does seem like an interesting thing that they have not participated despite the fact that gold has rallied.
Well, after you look at the charts and you come to some conclusion or perspective, let me know.
You better believe it. Yeah.
All right. So going back to gold and silver and purchasing silver, being bullish on silver, there's a prevailing theory out there that with gold now, sitting at 3,000 and there's so many positive tailwinds behind it, pushing it higher. There's major banks that are now re-rating the gold price to between 3,500 and 4,000 by the end of the year. So now they're alerting their clients, hey, look, this is where we see gold going. So likely there's going to be larger big money buyers of gold, over the 2025. And if we do get the rocky period that you're talking about, people are going to want to be hedging anyway. And so likely it's going to be short-term bonds and gold, right? Yes. So if as gold continues to move higher and higher and higher, 3,500, 4,000, and the retail investor sees, I got to get on this train. This train just keeps moving. And I thought it was an anomaly, but it's not. It's going higher and higher. But to buy 1 ounce of gold for 3,500, 4,000, 4,500, whatever, I can get X amount for silver. Silver's $35, silver's $40, silver's $45. That's a lot cheaper. They're both, it's the poor man's gold. Do you see that psychological effect taking place and more of the retail investor, pumping into silver when whatever that psychological threshold for gold takes place?
Well, I absolutely see it happening. I think, and if it happens, it doesn't matter if it's the right conclusion or the wrong conclusion by the world, by the crowd, because central banks are not buying silver, which is interesting to me. They've been buying gold specifically. They're not buying silver. And that's one of the reasons that ratio is bumped out. But as we said before, it has always happened in the past when gold gets stretched compared to silver that people make that exact calculation in their head, which, by the way, my next Twitter poll is going to be because most of the people who follow me on Twitter are very much into the markets, is what their exposure is on gold. Because I bet we'd be surprised at the underexposure to gold. When I talk to my friends, and my friends are all pretty sophisticated investors and not outside of the finance business, most of them are not represented in gold or silver. But to your point, I believe that's going to happen for sure. And I think $50 silver within the next year is not unreasonable.
Okay. Hey, I want I want to welcome everyone listening to this interview, this fantastic interview with Jim Urio, Managing Director of TJM Institutional Services right now. This has been an amazing discussion. And before we wrap up here with our final set of questions for Jim, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content. All premium content provides a comprehensive analysis of global trends, asset sentiment, and deep dives on individual miners for more informed decision-making. Even without premium, though, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. And thank you again for watching this fantastic video with Jim. Now, I'm positive you've enjoyed it as much as I have. Would you please let Jim know by hitting the like and subscribe button and leaving a comment below the video? All right, Jim, let's finish off our discussion we're having here with what I call a lightning round. Okay, I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100. I'm not going to ask you companies or anything like that. Okay.
I will only play this game if like every third question is about the NCAA tournament and I get to comment on a basketball game as well.
All right, so since you're from Chicago, I'm assuming you love Duke and you think Duke's going to win.
No, I do think Duke's going to win, but I hate Duke and I root against them at every chance I get. And I have deep-seated reasons why I hate Duke, which I'd love to get into. Are we
talking the Bobby Hurley, Christian Laettner era?
No, we're talking about just Duke has made some steps toward wokeness over the last 10 years. Okay. I don't know. Most of the people I assume are watching this are hard money people. So that always kind of, we always kind of think alike. But Duke treated my daughter very poorly when she was applying there and they didn't accept her. And the reason they didn't accept her is, well, we'll talk about it another time. But I think Duke's going to win.
Hey, yeah. Reason to hold a grudge.
No, don't I hold a grudge. But
we're taking that one to the end.
Exactly, right.
All right, so let's rank a few assets as a buy or sell by giving it a score of 1 to 100, with 100 being an extreme buy. And
what about time? What time frame are we talking about?
Now.
I'll give the time frame.
Now.
Right?
Yeah.
Okay.
Yeah, but like I'm saying, as of right now, how do you view it, right?
Got it. Yeah.
All right, so 100 being an extreme buy, 1 being an extreme sell. Then just give 1 to 2 sentences on why you take that position. We're doing a lightning round here, okay?
Let's go.
All right. 1 to 100 is gold a buy or a sell right now, and why?
75. I actually think in this year, gold is going to pull back within the next couple months to about 29.30 and maybe as far as 28.50, only by virtue of the fact that it's gone up so far, just a market positioning move. And when it gets down to those levels, I think it goes to a 90. But right now I have it, let's call it a 70.
Okay. Gold miners, 1 to 100.
I think I have that higher than gold right now. I do think the pullback could happen soon, like I said, in gold. But if I'm looking for something to own for the next couple of years, I think miners is an excellent thing, and I'll give that an 82.
Okay. Silver.
91.
Okay, and why?
With no comments, just because I think it catches up, like we've said before. Okay. I think it's interesting, and I think people will make that psychological movement to silver from gold.
Okay, now silver miners, there's only a few of them in the world. You know, most silver is a byproduct of other mining activities. In fact, it's about 2/3. But silver miners, 1 to 100.
50, neutral on those.
Okay. Copper, 1 to 100.
You asked about the Illini basketball team. I would say 95 for the Illini basketball team. They play Kentucky tomorrow. See, I can just answer whatever questions I want.
I did ask about the Illini basketball team. My bad. I thought I was asking about copper, but it came out Illini.
No, I am. The reason I'm bullish copper, I gave a speech about 2 years ago at the New Orleans Investment Conference about copper and the reasons to own it. Structural undersupply. When Donald Trump became president, there was a moment in time I thought, okay, copper might take a hit or underperform because he's moving back the EV push. But then you realize that states still have the EV push. Other countries still have the EV push. Plus, defense is ramping up. Electricity is needed for AI. I have copper as a 86.
Okay. Uranium.
I have uranium as a 90. I think uranium, I'm in uranium. I think that we are making the realization that we need a lot of electricity, and the fringe lunatic lefties who thought that uranium was not something that we should ever be using are wrong. It literally, the safety standards of these things have gone through the roof. I think that no matter what you use for power, there is risk. And these people have to realize that, and uranium and nuclear is still the best option.
Yeah, and we've got big money behind it, right? Billionaires and all the big tech. And there's a lot of huge push behind media as well now. So yeah, I think the wind is behind them. So do you distinct separate the uranium metal from the uranium miners, or do you look at the miners as a separate category? How do you view that?
I own miners. I don't own uranium. And it was only because one of my analysts who knows way more about that space than they thought that was the place to be. I'm not sophisticated enough within that space to start parsing between the miners and the cake.
Okay.
Isn't that what's called yellow cake, uranium,
Yellow cake,
whatever?
Yeah. All right. Oil, 1 to 100.
55. I'm bullish oil. The 60 to 65 level on oil seems to be massive support. Okay. And when it goes below that, it seems like some real big money and interest comes into it, and people wells start coming offline, things like that. So Donald Trump is viewed as a drill baby drill president, but that takes 2 years for that notion to start showing up in increased supply. What's more likely is that once we get through this transitionary period, we kick into a higher demand period, which comes in the beginning of 2026 before supply of oil is there, and I think it goes higher. So I'm 55 to 57 on oil.
Are you a believer in the declining shale output theory?
Yeah, I mean, I believe that it's happening, and like the older wells kind of thing, or that we're kind of zapping total supply. Do you think, is that what you're asking or no?
Yeah, I was just wondering if you think the shale output is going to be decreasing, like it's already hit its peak.
Well, a lot of people believe that. I think I don't know. To tell you the truth, I'm going to back off on that question. I don't know the answer.
Okay, fair enough. All right, the NASDAQ, 1 to 100.
And below 50 is a sale, right?
Yeah.
So I would say a 30. We're down 15% in the NASDAQ. If we start to worry about China pulling more money out, we're in a time of risk reassessment. I don't love the NASDAQ right now. The Mag 7 we're stretched. And anyone thinks like the Mag 7 are stretched, so we're just going to get out of the Mag 7 and get into other stocks. It doesn't happen that elegantly. If the Mag 7 goes down, NVIDIA goes down, everything gets pulled with it. So I am kind of a sell in the NASDAQ, but not for very long. I think there's going to be a generational buy opportunity within the next 8 months.
I thought you were going to use Powell's term transitory. So
transitory. I should have used transitory.
All right. So the S&P 500.
I am a 45 on that, a sell, but getting towards less of a sell. The day, I think it was 3 weeks ago, and we looked, maybe it was a month ago, we started to break out on the upside from a technical kind of a bullish pennant pattern, and we immediately rejected it. That was the trigger for me to start buying puts. And it's been a good trade. I've made good trade on the way down. I've taken off a third of them so far at 5,400 in the S&P, which represents a 12 to 13% correction top to bottom. And we're about, I don't know, where are we now, around, let's call it 3,800 by the time you watch the video. And I think we could pull down another 300 or 400 points. And that's where I'll get off. I'll get rid of another 2/3 of my hedges and just keep small on.
Okay. Short-term treasuries.
Short-term treasuries, that's such a mixed bag. I think they represent value here. So I am a 60. And I think that, like you say, and we all know Buffett's got this huge cash stockpile. I think he's perfectly happy with owning short-term treasuries, even if they're giving us, what are they now, 3.8%? I think it's still an attractive rate. So I would say a 65.
Long-term treasuries.
Okay. So this is interesting because in the next couple months, I would be a 70 buy. But I actually think that the sheer supply that's going to hit the markets over the next couple of years will start to weigh hard on it. I think right now we're just in kind of a grace period that's happening. So in the next 6 months, I would be a 60% buy, and after that, I'd be a 35% sell.
Now, going back to the previous part of our conversation, did you say that you do expect long-term treasury rates, because of the sheer supply, to go up to the 7 to 8% range?
I didn't. I said that I think in the mid fives, the Fed comes back in and starts supporting the bond market,
Okay.
and that's when the things, my trade, my dollar hedge trade, that's when it really starts to excel, including the gold portion of it.
Okay. All right. So now on a scale of 1 to 10, with each representing a percentage like 1%, 2%, or 2.5%, where do you see inflation ending the year?
2.9%. I think the Jerome Powell's comfortable with 2.93% inflation. I don't think the tools are in place. Milton Friedman was wrong. I hate saying that. It makes me want to take a shower every time I say Milton Friedman was wrong. When he said that inflation is always and everywhere a monetary phenomenon, that's about 80% true. The real spike in inflation that we saw in 2020, 2021 is much to do with supply shock. And the people will say, well, supply shocks happen. It was the monetary stimulus that caused inflation. Now we're just splitting hairs. The question becomes, do we see this massive global supply shock happening again? And I know you can't predict these things too, but if you're a student of history, they don't happen very often. You have to say they're probably not going to happen. So I don't think 4.5% inflation is going to come back. I think it'll stay around 2.9 to 3, which is high, by the way.
Yeah, but it plays into the devaluation
Exactly.
concept. Yeah. All right. So lastly, the recommended portfolio allocation used to be 60-40, 60% stocks, 40% bonds. This seems to be changing radically. If you were to include the various asset classes that we've discussed, everything, what would be your approximate recommended portfolio allocation today?
So Jared Dillian just wrote a book. You know Jared, right?
Yes, I've had.
He wrote a book called Money, No Worries, whatever. And I really loved what he said, but I'd like to make some tweaks on it. He's done back tests on a portfolio that was 20% stocks, 20% gold, 20% bonds, 20% real estate, and 20% cash. And that portfolio, and again, this is not my answer to the question.
Cash being short-term treasuries?
Cash being short-term treasuries, which are wonderful now. Like I asked that exact question when he was saying to me. So back tested, that portfolio gets you 8%. With only 12% drawdowns over the last, since the 70s. I think that is not right for everybody because I think your stock percentage should be higher than that. But I love the fact that he's adding gold, real estate into the mix there. So I would say if I change that to double his portfolio, to double his allocation to stocks to 35 to 40%, and then adjust the remaining four things accordingly, that's what I think for someone. And I'm 60 years old, so I think I got 40 more years to live. Yeah, I know. Maybe I'm a little ambitious. So
hey,
I'm young.
You're in good shape. You're in good shape.
So I'm very young, is what I'm saying. So someone who has a time horizon of 30 to 40 years, I think that's good. If you're someone 75 and in poor health, then I think you should be doing something different. Which, by the way, people, these are not recommendations. I don't know your risk tolerance or the depth of your pockets. I have a team of lawyers who tell me to say that every time.
This is just a generalization, but do commodities play a role in your portfolio there in the stock section? So you say 40, we'll call it 40%. Are we saying 10% commodities?
Yeah, I'm glad that you brought that up because I forgot to add that in because I do have that, the DBC commodity index. I do own that, and I believe that's a huge part of it. So that the metals part, the gold, and this might hurt you because you're a gold guy, but I think the 20% of gold allocation is the right allocation, but then another 10% that includes copper, silver, some of the more industrial commodities.
Maybe some of the miners.
Bingo. Yeah.
Okay, so we're looking 30% total of the portfolio.
In that space.
And then, so you got 30 there, you got 40 in the traditional markets, NASDAQ, S&P, et cetera. So that leaves 30% for
real estate. And then the bonds and cash don't excite me that much. Yeah. So 10% in each of those is fine. Okay. 5% in each, whatever the leftover is. Yeah.
Interesting. All right. Well, hey, Jim, thank you so much for coming on to Metals and Miners. It's been awesome and wonderful to spend the time with you. Would you share a key takeaway that you'd like viewers to keep in mind, and then inform them how could they learn about your work, how they can connect with you, how they could check out your podcast, et cetera?
Thank you. Yeah. What I think the main takeaway here, and I've been saying this since the calendar flipped, is that if we thought that because Donald Trump has the corporate sector's back, it was going to be blue skies and smooth sailing from here, we were kidding ourselves. I think the transition is going to be rocky. Even if you're convinced, which I think I am, but not certain, that we're going to a better economic system, even if we believe that's happening, the transition is going to be rocky. So 2026 is when we should really start marking our scorecard for wins and losses. If you want to follow the stuff I do, follow me on Twitter at Jim Urio. That's JIMIUORIO. Our podcast is called The Future's Edge. It is mostly about finance, but then we branch into health because I actually have a belief, and I asked you about health in West Virginia too. That's one of my focuses, and I believe it's a massive economic issue is public health and the health of our country right now too. So that's why we have a lot of doctors on our show talking about different elements of that fight too. But please join us. We'd love to have you. And I'd love to do this show again too. This is a ton of fun.
Awesome. Outstanding. Jim, I've been following you for several years actually. And so everyone, if you have not been following Jim, please do. Wealth of information, wealth of knowledge, very connected. You want to get on.
Warning though, too. I do try to push buttons and piss people off sometimes. So if you have thin skin, maybe don't follow me.
Well, that's the Chicago in you.
It's the short guy, Chicago Italian.
That's awesome. Well, hey, Jim, thank you so much for being on. I'm definitely going to have you back on sometime soon. Appreciate you. And everybody else, thanks for watching.
Thank you, guys.
Okay. Hey, I want to welcome everyone listening to this interview, this fantastic interview with Jim Urio, Managing Director of TJM Institutional Services right now. This has been an amazing discussion. And before we wrap up here with our final set of questions for Jim, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.